Good evening, ladies and gentlemen. A warm welcome to all of you at ASK Investment Managers Quarterly Call. We'll wait for a minute for all the participants to join in. Ladies and gentlemen, we are waiting for the participants to join in. We'll exactly start in next 30 seconds. Once again, good evening, ladies and gentlemen. A warm welcome to all of you at ASK Investment Managers Quarterly Call. I am Gaurav Chakravarti and I'll moderate today's call for you. As you all know, India has now transitioned to a modern economy, wherein it has become more globally integrated and exports a fifth of its output compared to 1/16 at the time of independence. India's per capita GDP may expand in the next 25 years as it did in the previous 75 years. The resilient growth of the economy in the first half of the financial year has been the fastest among major economies, thereby strengthening macroeconomic stability with the strong pickup in the momentum of growth, and it also forms the part of our discussion today. And for that, we have Mr. Chetan Thakkar, Senior Portfolio Manager at ASK Investment Managers with us to assess the condition prevailing in the global and domestic market. And he shall take us through the highlights of our ASK Select portfolio. Chetan comes with a 15 years of work-ex with more than 9+ years in equity markets. He has been instrumental in managing our portfolios since the time he has joined us in 2015, and he has a deep sector research expertise specific to agriculture, chemicals, metal, mining, and mid-caps. Previously, he worked with companies like McKinsey and HSBC Invest Direct. I would request Chetan to cover broader trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of the ASK Select strategy. Insight on what happened in this financial year so far, where we stand now, and how we see things going forward. This will be followed by Q&A, so I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Chetan.
Sure. Thank you so much, Gaurav. Thank you, ladies and gentlemen, for joining us for this quarterly update call for the India Select portfolio. As Gaurav mentioned, we'll first go through a broad outlook on the economy, followed by what changes we've made to the portfolio and what is the thought process behind these changes. And then we'll open the floor for question and answers. So to begin, let us just start with what we've witnessed in the macro environment in this first half. So clearly, I think ever since the budget came out for this fiscal year, there was a clear direction that CAPEX was the way to go, and the government had increased the outlay on CAPEX. As we are in a year just ahead of the general elections, there is a full steamrolling of the CAPEXs in terms of implementation. And we can clearly see signs of that visible across a lot of sectors. So CAPEX intensity has continued to sustain in Q2 as well. We saw CAPEX intensity start to increase from Q1, which clearly is pointing towards a faster increase in steel and cement consumption, 7 to 8%. And apart from this, any other sector which is related to CAPEX has witnessed volume growth, which is significantly higher than what we witnessed historically. Going ahead, our sense is the CAPEX implementation programs will continue as we head into the election year, because the focus clearly is on ramping up CAPEXs and completing a lot of projects that have already been tendered and have been commissioned out. Coming to consumption demand continues to remain muted, and this was something that we were anticipating at the start of this fiscal year. We had actually witnessed slowdown of consumption demand in volume terms, especially from festive season of last year. The expectation was this will continue to a fair degree till the first half of this fiscal year. As we roll into the festive season, which has just gone by, the expectation was volume growth will start to pick up. We are seeing some signs of that across a lot of sectors. where the festive has gone off well. This is despite a backdrop where the Kharif output has been impacted because of the spatial distribution of the monsoon. Having said that, going ahead, our expectation is food inflation might remain sticky, which in turn can put some pressure on CPI. Currently, the ongoing Rabi season is also pointing towards a tad degree of late start in terms of acreage and area sown. Our expectation is as we move ahead, you should start to see uptake or pick up as far as the sowing activity of Rabi is concerned. I think as we head into Q4, there will be more clarity on how the output from the Rabi season is anticipated. So consumption demand has remained muted while the managements have been guiding for an uptick in demand towards the end of this quarter. It's a combination of both festive and a strong wedding season, which is also compressed in this 1 month period. In terms of the global outlook, things continue to remain lackluster. That has had an implication on exports. So exports are down in the first half by close to 9%. Clearly, it's a combination of two things. One is slowing global growth. Second, more importantly, is the destocking that is currently underway. Destocking essentially has two parts to it. One was that we had essentially during the COVID period seen an expansion in the inventory supply chains or the supply chains in general for a lot of industries. Now, what we witnessed is as supply chains have normalized, people have also started to move back to a more normalized cycle as far as their inventory management is concerned, which is having an impact on the volume growth, particularly in this fiscal year. As we move ahead, the expectation is that from Q4 onwards, you will start to see more normalized kind of growth on exports. That is largely driven by the fact that we should be done more or less with this entire impact of destocking. We have also witnessed an accentuated impact of exports from China. So China opened up in January of this year, but their demand has been lackluster, which has posed a lot of inventory to make way to the global markets, which has further put pressure both on prices and volumes. Having said that, the outlook from an export perspective is expected to move up from Q4. So next fiscal, you will have this benefit of exports also contributing to growth. So far this year, exports have been a drag as far as the GDP growth is concerned, despite which we have a very strong GDP growth as highlighted by Gaurav. It has largely been driven by increase in government final consumption expenditure and to a certain degree on the consumption expenditure on the domestic market side. Coming to input costs, this was a key reason why we had seen globally inflation had become sticky. What we are witnessing at this point of time is that input cost pressures have started to abate. We are seeing inflation also inch lower. That is also commiserated by both rate pauses that we witnessed here from RBI and the fact that Fed has also decided to still continue to hold on to rates with the expectation that you might start to see rate cycle turning the corner as we head into the next calendar year. What we are monitoring very closely is the Rabi season because that has an implication of higher inflation on food, which can in a way impact the CPI. Further, the evolving geopolitical situation and election calendar year, which comes now, is also an added monitorable, while the results of the state election are very heartening, and that continues to strengthen the base case scenario for all of us, which was that the current dispensation in most likelihood might continue to remain in place even in the next general election. Coming to the portfolios, I think what we wanted to highlight very clearly is the number of actions that we've seen on the India Select portfolio, starting this calendar year in particular. As just to step back a bit from the names that you see here, the broader thought process on rejigging this portfolio, the exercise that we've undertaken in the last 9 months, is clearly emitting from 2 or 3 themes, which we believe will continue to drive growth from a more medium to long-term perspective. These themes clearly are, one is that we believe manufacturing has become a big added lever for growth as far as the GDP is concerned. This was something or a segment that had been missing for many decades. The share of manufacturing in GDP had started to inch down as services became a torchbearer. But what we are witnessing, driven by government policy that have been in place now from 2017-18, be it GST, be it the production-linked incentive programs, the lower corporate tax rate, coupled with the environment where there is a strong tailwind of shifting manufacturing away from China, shifting manufacturing away from developed world, puts India in a bright spot there. So what we are witnessing at this point of time, given our interactions with a lot of managements, is that US clearly has an issue on labor cost, which is pushing industries there to essentially outsource to reduce cost. Similarly, from Europe, what we are witnessing is that there is a structural issue as far as energy cost is concerned, which has come to the forefront because of the geopolitical situation there. And even in terms of labor cost, which is higher in Europe, which is essentially pushing more and more companies to outsource, and India becomes a country of choice. This is something which we believe can transition much faster than China plus one. So the expectation is that manufacturing will get a boost both from an uptick in the domestic consumption itself, coupled with a very large opportunity that opens up, particularly from the export side. Second bit is more related to what we are witnessing in terms of the financial sector itself, given that the sector and the space has witnessed a cleanup and it's now geared to support a stronger growth on the GDP side. The expectation is that loan growth will continue to look up as the GDP growth expands. And given that our expectation is GDP growth acceleration will continue from a more medium to long term perspective, we've essentially increased weight on the lending side of the portfolio as well. A third theme which will be visible in the portfolios is more from a consumption perspective. In consumers, we continue to remain more bullish on consumer discretionary as compared to staples, because we believe discretionary provides an opportunity to play both increase in per capita income coupled with the entire theme of premiumization. While in case of staples, the scope of penetration-led growth remains limited, and hence premiumization remains the only key driver there. So this, in a nutshell, is the thought process behind the rejigging of this portfolio. These are the names that you see on your screen that we've added to the portfolio in this last 10-month period as we have rejigged the portfolio. Now, to sum this all up, this is what you see in terms of the sectoral drift for the portfolio. What you witness clearly is that while financial weight has started to inch up, it's moved from 25 to closer to 30. Within that demarcation, what you essentially see is banks are the one where we've increased weight from 11% to 17%. That is where a large degree of weight increase has happened. We've taken some weight off on insurance. So while general insurance weight continues to remain at 4, we've essentially made space on the banking side by trimming some bit of exposure on the life insurance exposure that was in the portfolio. The second big takeaway is the way you're seeing the infrastructure and engineering weight increase. So it's increased from 16% to 22%. What we've added here categorically and clearly is that we've increased allocation on defense, which was a missing link in the portfolio, and the endeavor was to strengthen this bit of the portfolio. So we've added weight on the defense side. We've added weight on consumables, which is linked more closely to economic activity in general. And construction is where we've added weight, which is largely Larsen and Toubro, which is now part of the portfolio. On consumption, while the weight has increased a tad bit, what you clearly see is that we have a higher allocation now to discretionary as compared to staples. Staples continues to remain at closer to the 5% mark, while we've added weight on the discretionary side. Automobile is another sector where we've essentially increased weight. This is again a beneficiary of what we expect to happen both from the domestic perspective as well as the export opportunity that we believe will open up as most of these larger companies look to outsource more work away from their existing or established production and manufacturing bases. And we believe that companies in India who have the right capability and strength will benefit from a more medium to long-term perspective as this transition happens. Chemicals, very clearly, we are seeing some degree of weakness there, which is largely emanating from what we are witnessing in the more near term, which is the entire destocking exercise. So what we've done is, while we've maintained weight there, we've essentially created space from the chemical sector. Having said that, we continue to remain more optimistic. At an opportune time, we'll probably look to see what we need to do in terms of weight increases here, because we believe this also remains crucial pillar of manufacturing and outsourcing from India, where India has a clear strength and capability. Energy is another pocket where we've essentially increased weight. This is an exposure to IOC. We believe that structurally GRMs can remain higher. That is a consequence of how refining capacities have shut down globally. That essentially means that as fuel demand does not inch lower and globally fuel demand continues to remain higher, we believe that GRM cycle can be more positive from a more medium to long-term perspective. On the marketing side, I think last year was a complete washout year, and what we are witnessing this year is a significant bump up year. That is on account of the fact that OMCs are being allowed to essentially retain some benefit to cover up for the losses of last year and strengthen their balance sheet as capex is continue at the OMC side to increase refining capacity. We've added some weight on utilities. This is our participation largely in JSW, where we've added weight. What we've taken off weight and where we remain underweight is more on the technology and IT side. Here, while we vacated some space, there are certain pockets which we continue to like. Having said that, whenever we feel there is an opportune cushion that is available on valuations, this pocket might again see some degree of weight increases. But for the time being, this is from where we've reduced weight to increase allocation in sectors which we believe will benefit from a more medium to long-term perspective. This is how the portfolio summary looks in terms of market cap. So very clearly, one thing which we wanted to highlight here is that if you look at the performance of the index itself in this particular year, what is very stark and very obvious is the fact that large cap performance has significantly been lower than how the mid cap has performed. Very clearly, our portfolios were positioned or structured more towards large cap and largish mid caps, which is a larger allocation for us. Having said that, as this portfolio has been rejigged today, what you witness is large cap weight has increased to 61% because that is where we believe you have a cushion of both margin of safety and opportunities to play. Coupled with that, we've also added some bit of weight to the small cap side. So essentially what you see here is a build-up of the actions that we've taken on the portfolio. And in summary, large cap weight has gone up from 50 to 61. This is also a combination of market effect, where some of our names have done well and which in turn has meant that they've turned into large caps. And that is also pushing the large cap weight higher. We continue to remain astutely focused on our investment philosophy of high quality, high growth, preservation of capital. And we keep that in focus even as we make the changes to the portfolio. Coming to the Q2 numbers in particular, in line with what we were anticipating, Q2 earnings have been driven more by margin expansion, while capex driven businesses have also witnessed volume growth, which was expected given the impetus that the government had on implementing these capexes. Domestic consumption has remained muted along with exports, which has dragged the volume growth. While on the flip side, you've seen normalization of margins, which has essentially driven the operating profit growth in Q2. As we look out, our expectation is volumes growth will start to contribute, and you will start to see some degree of improvement in margins also being supported by operating leverage that typically kicks in as you see volumes drive higher and the volume uptake happens. On financials in general, what we witnessed is numbers were in line with expectation, while there was some degree of weakness on chemical/pharma intermediates, which was driven by lower export volume and compression in spreads. This we believe is more transitory in nature. The structural tailwinds continue to hold strong, so you should start to see both volume uptick and improvement in margins as we fold on to FY25. Coming to IT, I think numbers have been in line with our expectation. They've continued to remain muted. As we look ahead, we will probably look for more signs emanating from how global growth is expected to shape up and behave. Because if global growth starts to look up, what we believe will happen is the discretionary cut that has happened that will start to come back. You will see again spends start to move higher towards growth kind of projects, as opposed to what we are witnessing in the current environment, which is typically more cost optimization and cost takeout projects. On pharma in particular, we witnessed better than expected results. This is largely driven by stable volumes on the domestic front and margin expansion as lower input costs find their way to the P&L. On the US side of things, clearly one thing that stands out is this year we've seen a lower erosion in pricing because of drug shortages there, which in turn has meant that the US business or the export business from pharma also starts to look up. And this is a cyclical thing, but we believe it is here to stay for some more time. On the auto sector, we witnessed an expansion in margin as lower input costs start to hold into the P&L, coupled with higher sales volume, which is driving operating leverage, which in turn is driving OP growth for the sector as a whole. On consumer discretionary, volumes have remained muted in line with our expectation as festive this year was a month delayed. While the commentary continues to point towards a buoyant festive season, followed by a good wedding season. So we should start to see uptick on the volume side on the discretionary bit of the market, as well as we look on ahead into the Q3 and Q4 numbers. In terms of numbers, this is how the operating profit metric stands for Q2 FY24. We've essentially seen 24% operating profit growth in the quarter, which has led to a 35% PAT growth. Compared to that, we've seen a nifty 50 X of OMC OP growth of 21% and a PAT growth of 28%. Putting all weights together, the OP growth for the benchmark stands at 17% and the PAT growth of 22%. As we look ahead for FY24 per se, one thing which we wanted to point out very clearly is that while operating profit and PAT growth look higher at 23%, it comes on the back of 15% sales growth. That is largely on account of muted volume sitting there. As we fold on to FY25, the expectation is volume growth starts to come back, which is where we expect an uptick on the revenue growth. So revenue growth starts to inch higher to 19%, while OP growth gets some degree of operating leverage as we move into FY25. Coming to the portfolio from a more psychography point of view, the ROC of the portfolio continues to remain high at close to 33% for FY25. The growth expectation continues to remain elevated at 24%. We've shown both numbers, including OMCs and X of OMCs. OMCs have seen a very sharp uptick in profit today, and hence there is some degree of skewness as far as their contribution in FY24 is concerned. If we negate that off, we are essentially talking about a 23% OP growth in 24 and 24% OP growth in FY25. An interesting bit to note is how valuations have behaved. So valuations have essentially inched lower for the portfolio. This is on account of the portfolio witnessing earnings growth in FY23, witnessing earnings growth in FY24, but we've not seen that degree of commensurate returns in FY23, which has meant that valuations to a certain extent have corrected. And now why this is more important is the fact that a large degree of this derating was primarily on account of how cost of capital globally behaved last year. Our expectation is that as we move ahead and look ahead from a more medium-term perspective, that headwind starts to converge as a tailwind, and as interest rate cycle globally start to inch lower, you will get some degree of re-rating because we've seen a large part of impact on account of derating on account of very sharp increase in global cost of capital. That is clearly visible on this chart. So this is essentially 1 year and 2 year forward PE for the portfolio. So if you look at that, we've essentially corrected to a fair degree as far as valuations are concerned. There is also a play of the changes that we've made. If we were to negate that off, our assessment is that you would have still seen 25-26% kind of compression on PE, primarily because of increase in cost of capital. So that is the kind of tailwind that we expect starts to play out from a more medium to long-term perspective. Having said that, the endeavor of making all the changes is, can we start catching up 150 to 200 basis points on the performance over and above the benchmark? As we look ahead, we started to see some degree of that happen in the more lower frequency numbers, which is essentially your monthly numbers. We are seeing that even on the fiscal performance. So the expectation is that as we made these changes, we start to do a catch up there. And whenever the tailwind follows through on cost of capital, that will be an added lever as far as the returns for the portfolio are concerned. With this, I would like to take a pause here, and we'll be happy to take any questions that you have. Gaurav, you're on mute, so we can't hear you.
Sorry. Thank you, Chetan, for a detailed brief on the portfolio and the sectors as a whole. I request all the participants to type in your questions on the chat box. We shall try to curate all of them. While we go ahead, Chetan, we have got few questions in advance at our end. So I'd like to, get your take on those questions. Let me first put the first question to you. There are different kind of narratives going on in the market. This will do good, this kind of theme will work. So in that context, how we are going to position India Select portfolio and its outlook going ahead?
Gaurav rightly said, I think our sense is that the markets also go through cycles. One style essentially does not deliver return at all points of time, and you see that sector rotation and style rotation happen. Having said that, we very firmly believe that the key tenets to generating return continues to remain quality of earnings and earnings growth, and that is what we've always remained very focused on. So as we've rejigged this portfolio, we continue to keep that broader investment philosophy in mind and to populate the portfolio with changes where we believe that the growth momentum will remain higher for a longer period of time. So both durability of growth, the quality of growth, and sustainability of growth, which we've always talked about, continues to remain our driving force and driving factor as we made these changes. While the markets will go through their cycles, our expectation is and our experience suggests that if we've got these tenets right, you will essentially start to see that getting reflected in returns from a more medium to long term perspective. So the endeavor while making these changes is not to do something which we've not done, it's to remain consistently focused on what we believe are the key tenets for return generation, and we've kept that in mind as we made those changes.
Great. Now, a question to your end from participants. We have done quite a few changes in the portfolio, which you have also narrated in your presentation. What are the likely portfolio churns to happen in the next 3 months, if you can give
So
some?
there are still certain pockets where we believe we can still strengthen weight. One clearly is what we are witnessing today is from a more utility. So if you look at the portfolio in general and overall, what you essentially see is where we are underexposed. So we are underexposed on utilities to some degree. We are underexposed on commodities to some degree, and we are underexposed on IT. Now, coming to utilities and commodities, what we believe is that, and the way we have played so far on the real estate bit as well, is that this will essentially open up pockets and spaces for indirect plays as these sectors start to grow. So if it's utilities, you will essentially start to see financiers of these utilities start to do well. So that is a space where we are monitoring to see if there is an opportunity to increase weight there. Similarly, if you look at the entire piece on commodities, so very clearly something like steel, where we are seeing a lot of capacity addition happen, can we find plays within that which are indirect beneficiaries of consumables in this pocket where we can participate. So one of the changes that we've made is again like on the industrial consumable side. So we believe that that is the way that we would like to approach this, because some of these businesses will have ROCs cyclically adjusted which are lower than what we seek from these businesses. So the endeavor is that as capacities get built there, as utilization start to inch up there, can we find indirect plays which essentially benefit from that, and they form a part of the portfolio which meet our criteria of both quality and growth. So there is still some degree of changes that can happen, but by and large, a very large churn has already been witnessed in the portfolio as we've rejigged the portfolio in this calendar year in particular.
Thanks, Chetan. Now, in respect to the performance, it has been quite tricky for us over the last couple of years in specific, albeit this financial year, where we have seen a sharp movement in our portfolio performance, which you have mentioned in your call as well. So can you please highlight or help us to know what are the contributors who has contributed towards this financial year's performance? And also in the recent past, we have added a lot of names, and what we are expecting in terms of the performance going ahead. Is it going to stay, or this is going to be the new normal for us in terms of the performance, which will in turn help cover the lost ground?
So very clearly, I think where we've been positively surprised is where a large part of the performance has come in terms of earnings, where the street has been positively surprised. So some bit of that is to do with capex. So we've actually seen an uptick in capex cycles. So some of our exposures there, be it indirectly through cables and wires, have essentially done well in this period, and that have contributed to returns. Some bit of industrial consumables have contributed to that return in this fiscal year. So the expectation is, as we were doing these changes also, is to ensure that we essentially catch up 150 to 200 basis point. And the idea is to reposition the portfolio to pockets which we believe where the growth will be higher for a longer durable period of time, and they should start to contribute to this catch up. So the idea right now very clearly is to play the catch up whenever that tailwind of cost of capital plays out. That is an added lever. We don't count on that to catch up performance for us. So that still continues to be an added contributor, which will play out as we look ahead. From our internal perspective, clearly the focus right now is on rejigging the portfolio to ensure we start catching up on the underperformance of last year. Having said that, our sense is we've not got compensated for the earnings return or the earnings delivery of last year. So at some stage, these stocks will start to reflect that. We continue to remain more focused on high quality, high growth. I think that part of the market has not done too well in the last year, as a lot of catch up was happening on the value part. Even if you look at the value part more closely, what you will essentially observe is that a large part of the uptick has essentially happened only when you've essentially seen a very fast normalization in ROEs, be it in case of PSU banks, which was faster than what was anticipated. This was largely driven by the policy cycle, where interest rates started to inch up very fast. If you stretch this out to a more longer to medium term perspective, I think the market will again refocus on who's capable to deliver higher growth. That in turn will get limited by the ROCs or ROEs of those businesses. So our assessment is that businesses that we own are more geared, are more capable to deliver faster growth in terms of earnings, and we need to get compensated for the earnings growth that has already happened in the portfolio, and the returns have not been commensurate to that. So our sense is we are seeing some degree of early signs of that in this fiscal year, but the expectation is we should continue to build on to that.
Okay, so when you point out on those parts of the earnings as well, also you mentioned the valuation for a portfolio has corrected over the last 1 year or two. So looking ahead, also in terms of the tailwinds you spoke about will play and the catch up will happen, and also the news which you got from Fed in terms of the rate cycle, which also adds a lot of positivity into it. So what do you think going ahead with this, valuation and the interest rate cycle, it will play in favor of us? And if yes, then how quickly it will, showcase in the portfolio performance?
So, Gaurav, very difficult to time when. Very clearly, these things happen gradually over a period of time. I think the reason why it happened so rapidly last year is because you saw Fed move from zero point 0.5 to 5. And this is a very large quantum of jump in a year's time, while we were anticipating rates to harden. But I don't think any of us would have penciled in a zero point 0.5 to 5 as we were looking at that year. Having said that, as we look ahead, our sense is that one, cost of capital globally can start to inch lower. Whenever that happens, it will happen. More importantly, what is likely to happen is with the inclusion of India on the global bond indices, you will actually see the cost of capital on the domestic side also start to inch lower. Now, this will be a very gradual phenomena. On a year-to-year basis, we might not be able to observe or appreciate this. But if we look 10 years ahead and when we start to look back is when we will probably be able to see the positive impact of essentially a fact that India has higher growth, has a higher fiscal stability in that environment and a higher governance stability. So our sense is when you look at a country risk premium, that in our assessment can start to inch lower, and that demand for a higher country risk premium moving down will also mean that cost of capital, both from a domestic perspective, irrespective to what happens globally, also starts to positively impact us. So difficult to say when, but clearly directionally we can say probably we are at peak in terms of rates. It will stay here as a plateau. Very difficult to call for how long. But I think Fed has given some bit of signs yesterday in their release to say that what is their expectation.
Thanks, Chetan. In the meantime, request all the participants to type in your questions on the chat box. We shall try to curate all of them. We have another question. Like, as you spoke about the valuations, the earnings, the portfolio contour put together. So there has been a classic dichotomy going on in the market, at which is good, mid cap or a large cap. And some has the narrative the large cap will play well going ahead. What the signs which you are seeing? So what's your take? And also, as you said, that few of our mid cap companies has translated into large cap, which has increased our exposure in the large cap in terms of the percentage. So what your take on it with a large cap or mid cap, and how the construct is going to be?
So we very clearly believed that there are very crucial investment tenets. Wherever we see those tenets is where we essentially become quite excited in building positions there. So that remains our key objective. Our sense is market cap is a journey. If the companies deliver on quality and earnings, they'll go through that journey. So we very clearly remain still very focused on identifying companies and names which show the tenets that we require from those kind of investments and from investments in general. And our sense is market cap will essentially follow through if we've identified the right name. So we've seen that play out Historically, in a lot of our names, be it a Bajaj Finance, be it a PI, be it Havels historically, which was a part of this portfolio, we've actually seen most of these companies as they've gone through this journey of improving growth along with quality of growth, sustainability, and durability. You've seen markets reward them in terms of how the market values this. And that in turn has meant that they have transitioned from being mid caps to large caps today. So our sense is we remain very focused on identifying these characters in the businesses as we build positions in these businesses.
Great. Now coming to few stock specific questions, as we have already trimmed a lot of positions in 4 or 5 stocks in the recent past, and we also got some money by booking profits from those names and created liquidity. And consequently, we have increased our exposure to some new names like an RK Forging, REC, Sirma SGS, and HAL. So your views on these stocks in specific and how they are going to impact the portfolio performance going ahead.
So, like very clearly, the idea was to identify themes and spaces which will benefit from what we are witnessing both locally and globally. And we believe manufacturing defense clearly stands out there. Like I mentioned, that if we want to play utilities indirectly, financing of utilities is also a right way to play it. So most of these positions have been built keeping that in mind. So when you look at REC, what we had witnessed was the power sector was plagued with a fair degree of indiscipline on the discom side, which meant that that entire space was essentially hampered and was putting a lot of pressure on the financiers as well because they were turning into non-performing assets. There have been a lot of steps the central government has taken to ensure that this space also goes through a period of transition. It cleans up a lot of these issues of the past can be dealt with, and you see discoms also become more healthy, which in turn makes the entire chain more healthy. Our sense is we are probably at the cusp of that. There is a long way to go. The entire smart meter opportunity, what that smart meter can mean in terms of how we pay today for utilities might change, which in turn might make it prepaid from postpaid, which is a very significant change when you look at the working capital that gets blocked on the utility side, starting from discoms to transmission companies to utilities. That in turn can mean that quality of earnings for those pockets can improve. That in turn can mean more capacities can be added. Overall, in turn, can mean power cost goes down and it makes the economy more competitive globally. So very clearly, this is a pocket where we believe that while there is a sharp focus on renewables, as the country accelerates on growth, what you will need is a base load taking capacity on the thermal side, and the expectation is that you will see additions there also. So that is an idea behind adding this exposure. Coming to Sirma in particular, I think EMS space is a space where there is a clear focus today on localizing. There is a large opportunity which is opened up even globally as people start to shift supply chain away. So it's both on the domestic and on the export side. Today, this name is more into the assembly side of PCBs. Our sense is as localization picks up and that we witness across a lot of geographies, across a lot of industries, the first bit is more on assembly. What follows through is the parts that can be localized further in that entire value chain and to grab a fair degree of value addition there. So our sense is this is a pocket which can deliver 15 to 30% kind of growth from a more medium term perspective, given the opportunity that is available and with reasonable degree of quality of earnings growth as they do that. So that is the reason why we've increased weight there. Coming to the defense exposure, very clearly a lot of names or the entire pack in general, what we are witnessing is because of government's focus on being very focused on manufacturing from India. That is something which will bode well for the space. What we had witnessed historically was a more start-stop kind of a policy environment. What we see today is clear tendering that is happening on that space, so that provides a long-term visibility in terms of order book and execution. Also, I think the current geopolitical situation, what that opens up to is very clearly a fact that if geopolitically things are very difficult, you cannot rely on importing most of your component requirements on the defense side because defense takes priority. So there is a clear focus from government to say that this is an area where we need to become independent, need to become self-dependent, so that in whatever adverse situation, we have the capabilities internally in the country to build for at least our own requirement. As you know, geopolitically, we are in a spot where we are between two big giants on the borders. So we are in a situation where we might have to look at probably being ready on both the borders of the country. So this is a clear policy focus area. We are seeing ordering and tendering happen there. Capability was already strong here, and we are actually starting to see execution there where capability was weak. Very clearly, there is a global belief that if the opportunity stays in India, a lot of the global players would want to partner in technology transfer here. So we are starting to see news flow there. Our sense is from a more medium to long term perspective, you will actually start to see that play out even in terms of ordering and tendering. So if it's a HAL, there is a big MRO opportunity that opens up on the civil aviation side, which was missing. There is an engine opportunity that opens up from a GE's perspective. So there are a lot of things that are happening there. So really exciting times there. And hence we believe that quality of businesses there met our parameters, and wherever they fulfill our quality parameter and growth parameter is where we've gone ahead and added.
Thank you, Chetan. We have also added position into IOC. Your take on it and the space altogether.
So that is what I mentioned in my commentary. I think GRM is something where we believe there is a structural tailwind, primarily because of how refining capacities have shut down globally, while fuel demand still continues to remain higher. So I think pre-COVID globally, we were at 100 million barrels per day consumption. That, according to IEA, has inched up to 104 and 105, despite all the push on electrification of the automotive chain. So our sense there is that as volume growth still continue to inch higher, the peak remains some time off. You will need refining capacities globally, and you are in a situation where some bit of refineries have been taken off block. So that essentially means historically, if we had seen a $3 to $4 kind of a more normalized GRM environment, looking ahead, we can probably anticipate some degree of higher GRM environment. Coupled with that, most of these refineries have gone ahead with the capexes in India. So they've essentially increased their product slate, which means they've added more complexity. So structurally, also the businesses here have added to the GRM lever by improving the product slate where they play. Petchem will always still continue to remain as an opportunity. So that is one pocket which can also open up from a more long-term perspective, and businesses can transition there. Having said that, hydrogen very clearly is a fuel for the future. While a lot of companies are working on green hydrogen, trying to bring down cost, gray hydrogen is something that comes with refining capacity. So in a way, the hydrogen ecosystem can to some degree see a kickstart from the refining side of things. They have the balance sheets also to go ahead and deploy. And now clearly they have clear direction and policy framework from a government perspective also to push in that direction. So our sense is if the environment allows them to make more normalized marketing profits, the view that emanates is the risk on the marketing margin side is not as high as what we've seen historically, with a cycle which is favorable on the GRM side. From a valuation perspective, valuations are extremely compelling here. So I think the markets were rightfully so building in a fair degree of risk there because of actions of the past. But our sense is we are probably looking at a future where things can be better or different from what we had seen in the past. And that should bode well because valuations remain very conducive.
Great. Now, in specific to a sector like specialty chemical, they had a dream run during the COVID time, and almost 1.5 years or two, they have underperformed. Do you think that this can be a contra play because we have our exposure there as well? Also, in line with that, your take on PI industries as of now. We've got some
So,
news on PI specific.
yes, so you rightly mentioned. I think what we've seen on the specialty chemical side is they had benefited from stretching of the supply chain. That had meant that if the end user industries were storing for 30-day period in COVID because of supply disruptions, people moved to 60, 65 days. So that clearly means there was inventory that was sitting there from a fear that the supply bottlenecks will still continue. Because from a more customer perspective, even non-availability of one intermediate can impact their production. As those bottlenecks have eased off, people have started to go back to a more normalized kind of inventory cycle. So we've seen an impact of that as far as volume growth for this year is concerned. Coupled with that, there has been a higher degree of intensity of exports from China because growth there has not been in line with what they were also anticipating. So that has meant that higher inventories have flown into the global market. As we look ahead and in our interactions, very clearly, the tailwind still continues to remain strong on the opportunity that is there. be it in terms of export opportunity or the domestic opportunity. So that opportunity continues to remain intact. I think it's got an added leg from what we are seeing from outsourcing opportunity from Europe and US as well. Where earlier our sense was China plus one will happen more gradually. I think both these geographies will probably accelerate the transition there. So capex intensity has not come down for the space, so that points towards a buoyant outlook from a more medium to long term perspective. Very clearly, this is a pocket where the country has strong capabilities, and our sense is that we will continue to gain global market share in this particular market. So the expectation that can this sector deliver 10 to 12% growth over a more medium to long term, that continues to remain intact, and any name which has the right set of capabilities, right set of balance sheet strength, should ideally grow at a rate much faster than this. Coming to PI on specific, I think PI has a very strong chemistry capability, which has essentially got them where they are today in terms of their performance, both in terms of earnings, profits, and how the stock has behaved from a more medium to long term perspective. Having said that, on the CSM side, there is an exposure on a single product, which is on the higher side, which has also had a very good run. But the fact is, as it happens with most cases and with most products, they also go through the life cycle. Patented products at some stage get into generic products. In that environment, what you typically witness is while price is correct, you see a very sharp uptick in volumes because of pricing becoming more affordable. So our sense is that there is some apprehension of how that product will behave in a very short term. Our assessment is volume uptake will continue to happen there, even if it becomes more generic. Coupled with that, given their chemistry capability, there are products in the pipeline which can scale up as that happens. They've added an extra lever on the pharma side, which is a far bigger opportunity than agrochem, which gets into their staple. This was one place where they were looking to find a foray. I think last year's acquisitions has now positioned them to foray into the pharma side of things, where size of opportunity itself is fairly large. Typically, what happens is pharma is a business which has a longer approval process, a longer process of getting customer due diligence done, but a way more stable and sticky business with a fairly large degree of size of opportunity. So our sense is from a more medium to long term perspective, the portfolio looks positioned well. They have products on the agrochem side also, which are expected to scale up. So even if scale down happens here, you should ideally structurally start, you will structurally see growth sustaining, while there can be some implication in terms of how earnings will behave from a very near term perspective if you actually see a fair degree of higher competition. So we are keeping a very close eye on what is happening on PI, but our belief on their chemistry capability sets them still apart from the rest of the players, and we continue to hold the position here for the time being.
Thanks, Chetan. We'll take last question for the day. Uh, you know, times are getting very interesting. Sensex hitting all-time highs, numbers are going higher and higher, and we are getting a lot of IPOs on the market. Are you getting anything excited in any such IPOs in the near term? Are you going to, or you are looking into any such names at this point of time?
So I think we are keeping obviously a very close eye on all IPOs. All IPOs get evaluated internally at our investment team level to see wherever there is merit, can we participate there. There are certain IPOs where essentially if valuations are not too conducive for us to participate, we stay away. So we are basically investigating all IPOs on their merit and to see, given the platform, which is the PMS platform, how well we can build those positions, because typically on the PMS platform, we participate on the secondary market, which is where you've already seen a pop-up on valuations as they list. Having said that, I think where we find opportunities, we participate. So something like a JSW Infra, where we saw there was an opportunity, we participate. So we are keeping a very close eye there. Wherever we sense an opportunity, we'll obviously look to participate.
Great. Thank you so much for all the answers. Now we'll be closing this webinar, and I request you to give some closing comments.
So thank you everyone for joining us on this call. In summation, the only thing that I would like to highlight is our portfolios have delivered on earnings growth that we anticipated or expected them to deliver. Certain parts of the portfolio have done fairly better than what was expected from them. As we look ahead, our sense is with acceleration in economic growth, the earnings acceleration should follow through. If you look back in the last 3 years, these last 3 years have been years of very significant disruption, which were brought on primarily on account of COVID, and even after that. Even in this highly disrupted environment, I think what really bodes well is the fact that as India emerges out of this entire turbulence, we've emerged out much more stronger. We've emerged out as a country and as a play, which is a significant bright spot as far as more medium to longer term growth outlook and aspiration is concerned. So our sense is we've got the framework, we've got the pillars in place to drive and accelerate growth. The foundation has been laid. So as we look ahead, we expect acceleration should translate into wealth generation. We are being very focused on what we believe are the tenets or characters that are needed to create wealth over a longer period of time. And the idea to reposition the portfolios is always to keep the more medium to long term into perspective, as opposed to very short term knee-jerk kind of reactions. So we continue to stick to that philosophy. So the expectation is we start to do that catch up. We are seeing some signs of that in fiscal. Keeping fingers crossed, we see a faster acceleration on that direction as we hit 2024. As we are already into December, would like to wish everyone a very happy new year, and hoping next calendar year we essentially start to see a fair degree of acceleration on the returns. So thank you so much for joining us. We'll again connect in the next quarter. Thanks a lot. Thank you, Gaurav.
Thank you, Chetan, for your closing comments. And yes, we are keeping all our finger crossed. 2024 with the year of more prosperity for everyone as well as for our portfolios as well. Thank you all the participants for attending today's call, and we shall be sharing a recording of the same. And this concludes today's call. Thank you once again.
Thank you, everyone. Thanks a lot.